Well, to best illuminate some of the key concepts in making charitable donations of non-cash assets, I thought it'd be best to go through 3 different case studies. Case study number 1, I call the commercial real estate contribution. It involves 4 senior doctors in Greenville, North Carolina, and they were considering selling their practice to 6 junior doctors. I also call this case study doctors with a good investment, believe it or not. So not only did I find doctors with a good investment, but they also were all charitably motivated, which is also quite odd for the medical profession, as you're well aware. So these 4 senior doctors had purchased their medical building in 1968. They had depreciated down that building each year to where their current cost basis was 0, all the way down to 0. And they had a real estate investment trust that each year in Charlotte, North Carolina would call and say, would you consider doing a sale and leaseback for your building? And each year the doctor said no, because if we were to do that, we would have to pay a lot of capital gains taxes. At the same time, we're getting ready to sell our medical practice to the 6 junior doctors. And if we do that and sell the building out from under them, then the junior doctors would not necessarily be as interested in moving forward with the practice sale. So where you negotiate everything in Greenville, North Carolina, this is true, is beer and barbecue. So what the junior doctors wanted was a long-term lease under reasonable terms, and what the real estate investment trust wanted was a long-term lease under reasonable terms. Clearly that's what needed to be negotiated. So over beer and barbecue, the junior doctors and the real estate investment trust managers came to a verbal understanding as to what that long-term lease would look like and what the terms would be. The junior doctors then came back and told the 4 senior doctors, it looks like we have a deal, so should you wish to move forward with selling the medical building, that's okay. That we will then go ahead and move forward ourselves with buying the practice, because we know that we're going to be here for the long term in the same location clearly that our patients have been coming to for the last 45 years or so. So with that information, the doctors worked with their financial advisors to develop the following plan. The goals that they had were very clear. First was to be able to save capital gains taxes on the sale of the building, because they were going to have a very big spike in income for selling their medical practice. Second, all 4 of the doctors, believe it or not, were charitably inclined. So they wanted to have some kind of charitable component to the plan. Third, they wanted to be able to save estate taxes to the extent possible by removing all of the commercial property out of their estate. And fourth, they wanted to be able to enhance their retirement income using this asset that has been illiquid for more than 45 years and make that non-working asset a working asset if possible, to be able to get income back for their full retirement. And fifth, what they wanted to be able to do was to make sure that their kids were going to be taken care of, or grandkids as well. So the plan went as follows. They took a 20% undivided interest in the medical building, 20%. Now I should also say that the REIT wanted to purchase the building based on the long-term lease that was verbally negotiated with the junior doctors for $6 million. The REIT was prepared to come in and pay $6 million for this building. So the doctors took a 20% interest in the building, and they put that into 4 charitable remainder trusts. I have on the slide, each one was 7%. They varied a bit, but each one had 20% interest of their individual holdings was placed into the charitable remainder trust. So let's stop there for a moment. What happened? All of the 20% contributed to the trusts is all out of the estate for estate tax purposes for each one of the doctors. 2, when the REIT comes in to purchase that property, no capital gains tax at the time of sale, and then all of that interest, 20% of $6 million, is $1.2 million. $1.2 million then becomes liquid, investable, that can generate then the retirement income as long as they live. Also, the third was it generated, of course, a charitable remainder interest that could then pour into any charity that the doctors wished. So that was the first component of the charitable plan. The second component of the plan was to take another 20% interest and contribute that to the local community foundation. They created 4 separate donor-advised funds. So a 20% interest to the charitable remainder trusts, 20% interest to the 4 donor-advised funds. What did they accomplish with the second component of the plan? All out of their estate for estate tax purposes. When the REIT comes in to purchase the medical building, the 20% given to the donor-advised funds, no capital gains taxes at all. And most importantly, they were able to use the lowest cost basis, highest appreciation, long-term capital gain asset that they had to be able to pre-fund all of their retirement charitable giving. So when they were moving into their second stage of life, they were able to use that then as the charitable bucket from which to make grants rather than cash out of their left pocket or some other less tax optimal way of making the contributions. So to summarize, a $6 million building that the senior doctors owned, 20% to charitable remainder trusts, to 4 charitable remainder trusts, 20% outright to the community foundation for 4 donor-advised funds. That means they gave away 40% of the building, 40%. But when the REIT comes in to purchase the building, 40% then is going to the community foundation and to the charitable remainder trusts. They're holding back 60% themselves, and almost, I wish the math worked out and it almost did, but all of the deductions received from the advised fund, 100% fair market value deduction there, and the deductions received from the charitable remainder trusts, about 35% or so based on the age, all those deductions almost were able to wash out all of the all of the capital gain for the amount that they held back for the 60%. So it made it very, very close to a tax-neutral sale. Not all the tax, but close. So then they were much more comfortable moving forward with the medical practice sale under a 5-year earnout. 2 of the doctors, said, we just disinherited our kids in one case or our grandkids in the other. So 2 of the doctors said, how about we take some of this additional tax savings and the retirement income that we're getting from the charitable remainder trusts and purchase a second-to-die life insurance policy to replace this amount of wealth for our kids. And another one did exactly the same thing, putting that obviously into an islet for the grandkids. So when all of the dust settles, you've got senior doctors transitioning out of their practice, using the lowest cost basis, highest appreciation, long-term capital gain asset they had, the medical building. The junior doctors being able, post-sale, to enter into a long-term lease under reasonable terms. The senior doctors using that asset, 20% for the charitable remainder trusts, 20% for the donor-advised funds, pre-funding all of their future giving, and perhaps the next generation's giving, because in 3 of the 4 charitable remainder trusts, they were going to have their donor-advised funds as the remainder beneficiary. So all that will just pour in upon death. One actually had it go over to East Carolina Medical University to top off a professorship that he had previously created there. But all out of the estate, for estate tax purposes, received the income that they were looking for from the trusts, made it very, very close to a tax-neutral sale for the 60% that they held back, and then the senior doctors were able to move forward, selling that practice to the junior doctors, and at the same time, for 2 of them, being able to replace that wealth down to the kids and or the grandkids using life insurance as the medium to do that.